Did you know that millions of UK retirees are running out of money faster than expected? Many enter retirement thinking they have enough savings, only to discover that their money isn't stretching as far as they thought. Hidden expenses, rising costs, and financial surprises are draining pension pots at an alarming rate. And most people don't even see it coming. Imagine spending decades working hard, saving diligently, and finally reaching your golden years, only to find out that your retirement budget is disappearing right before your eyes. Healthcare bills, home repairs, higher taxes, and unexpected family expenses can devastate your finances. And inflation, it's quietly eating away at your savings, making today's money worth much less in the future. But here's the scariest part. Most retirees don't realize these hidden costs until it's too late. Could you be one of them? Are you unknowingly walking into a financial trap that could leave you struggling in your later years? In today's video, we're exposing 9 shocking hidden costs of retirement in the UK, some of which will leave you speechless. If you think you're financially prepared, think again. You might be overlooking some of the biggest retirement expenses that could change your future. Stay with us until the end, because what you don't know about retirement could cost you thousands. And trust me, you won't want to miss this. Number 1. Higher taxes on pension income. Many retirees assume that once they stop working, their tax burden will decrease. However, in the UK, pension income is still taxable, and for some, the amount they owe can be higher than expected. While the state pension is received automatically, any additional income from private or workplace pensions is subject to income tax, often pushing retirees into a higher tax bracket without them realizing it. One of the biggest tax surprises comes from lump sum withdrawals. While the first 25% of a private pension is tax-free, any amount beyond that is added to total income for the year and taxed accordingly. This can unintentionally push retirees into the higher tax bracket, meaning they may pay 40% tax on part of their pension income instead of the standard 20%. Many retirees withdraw large amounts for major purchases or investments without realizing the tax implications, resulting in a much larger tax bill than anticipated. Another common issue is the combination of multiple income sources. Retirees who receive income from the state pension, private pensions, rental properties, or other investments may unknowingly exceed the basic tax threshold. As of 2025, any income above £12,570 is taxed at 20%, while income over £50,270 is taxed at 40%. Without careful planning, pensioners can end up paying significantly more tax than they expected. To avoid unnecessary tax burdens, retirees should consider withdrawing pension funds strategically, making use of tax-free allowances, and consulting a financial advisor for a personalised tax plan. Using ISAs for tax-free income, spreading withdrawals over multiple years, and ensuring all available tax benefits are utilised can help minimise tax liabilities and preserve retirement savings for longer. Proper planning is essential to avoid overpaying on pension income. Number 2. Rising healthcare and social care costs. Many retirees assume that healthcare in the UK is free, but the reality is far more complicated. While the NHS covers many medical needs, there are several hidden healthcare costs that can add up quickly in retirement. Routine services, such as dental care, eye tests, and hearing aids are not fully covered, meaning retirees must pay out of pocket for these essential treatments. Private healthcare is another expense that many retirees do not anticipate, but long NHS waiting times often push people to seek private consultations, which can cost hundreds or even thousands of pounds per year. One of the biggest financial shocks comes from social care costs, especially for those needing assistance with daily living. If a retiree requires home care or moves into a care home, they may have to pay significant amounts depending on their savings and assets. In the UK, individuals with assets above £23,250 are expected to fund their own care, which can be a heavy financial burden. The average cost of a private care home can range from £800 to £1,500 per week, meaning that over a few years, care expenses can easily wipe out a person's savings. Prescriptions, while subsidised, still require a co-payment unless retirees qualify for exemptions. For those with ongoing medical conditions, these costs can add up over time. Mobility aids such as wheelchairs, stair lifts, or home modifications to improve accessibility can also be unexpectedly expensive. While some financial support is available, many retirees end up covering these costs themselves. To prepare for these expenses, retirees should explore long-term care insurance, set aside savings specifically for healthcare, and stay informed about government support programs. Planning ahead can help avoid financial stress and ensure that healthcare needs are met without compromising retirement savings. Number 3. Inflation eating away your savings. Inflation is one of the biggest threats to retirement savings, yet many retirees underestimate its long-term impact. Over time, the cost of everyday essentials such as food, energy bills, and transportation continues to rise, eroding the purchasing power of a fixed retirement income. What seems like a comfortable pension today may not be enough to maintain the same lifestyle in 10 or 20 years. Even at a modest annual inflation rate of 3%, the value of savings can decline significantly over time. For example, if a retiree has £100,000 in savings today, in 20 years, that same amount will be worth the equivalent of only £55,000 in today's money. This means that without careful planning, retirees could find themselves struggling to cover basic living expenses as the years go by. One of the biggest challenges is that many pensions and savings plans do not automatically adjust for inflation. While the UK state pension does benefit from the triple lock system, which ensures annual increases, private pensions and personal savings are often left exposed to inflationary pressures. Fixed annuities, for example, provide a guaranteed income but do not increase over time, meaning their real value diminishes with each passing year. To combat inflation, retirees need a strategy that ensures their income keeps pace with rising costs. Investing in assets that historically outpace inflation, such as dividend-paying stocks, index funds, or property, can help protect retirement savings. Diversifying income sources, delaying large withdrawals, and considering inflation-linked annuities are also ways to mitigate financial risks. Without proactive financial planning, retirees may find that their savings do not stretch as far as they expected, leaving them vulnerable to financial shortfalls in the later years of retirement. Number 4. Unexpected home maintenance and repairs. Many retirees plan for everyday expenses, but often overlook the significant costs of maintaining their home. As properties age, they require ongoing repairs and upgrades, and these costs can quickly add up. A leaking roof, a broken boiler, or outdated plumbing may seem like minor issues, but without proper budgeting, they can turn into unexpected financial burdens. Home repairs are not just occasional expenses, they are inevitable over time. One of the most common unexpected costs is heating and plumbing repairs. A boiler replacement can cost anywhere from £3,000 to £5,000, while a full central heating upgrade could be even more expensive. Roof repairs are another major concern, with even small leaks potentially leading to structural damage if left unaddressed. Replacing a roof can cost tens of thousands of pounds, an expense many retirees do not anticipate. Other necessary home improvements, such as insulation upgrades, electrical rewiring, or replacing worn-out windows, also come with high costs. As retirees age, their homes may also need modifications to accommodate mobility issues. Installing stair lifts, grab bars, walk-in showers, or ramps can be essential for safety and comfort. But these modifications are often costly. While some grants and support programs are available, many homeowners must cover these expenses themselves. The best way to prepare for these expenses is to set up a dedicated home maintenance fund. Financial planners often recommend setting aside at least 1% of a home's value each year for repairs and upkeep. Regular inspections and preventative maintenance can also help identify potential problems before they become costly emergencies. Without proper planning, retirees risk being caught off guard by home repairs that can drain their savings and disrupt their retirement plans. Number 5. Supporting adult children financially. Many retirees expect to enjoy financial independence after decades of hard work, but a growing number find themselves financially supporting their adult children well into retirement, whether it is helping with rent, paying off university loans, or covering unexpected expenses. These contributions can significantly impact retirement savings. While parents want to help their children succeed, providing ongoing financial support can create long-term financial strain. One of the biggest reasons retirees continue supporting their children is the rising cost of living. High property prices make it difficult for young adults to afford their own homes, leading many to rely on parental support for mortgage deposits or rent payments. University tuition fees and student loans also leave many graduates in debt, with some parents stepping in to ease the financial burden. Additionally, job instability, economic downturns, and life emergencies often push adult children to seek financial assistance from their retired parents. The problem is that most retirees are living on a fixed income, and continuous financial support can deplete their savings faster than anticipated. Even small monthly contributions add up over time, reducing the amount available for essential expenses such as healthcare, home maintenance, and personal well-being. Retirees who do not set financial boundaries may find themselves struggling to cover their own costs later in life. To manage this challenge, it is important to set clear financial limits while encouraging financial independence. Retirees should establish a realistic budget that prioritizes their own needs first. Offering guidance on financial planning, rather than direct financial support, can help adult children become self-sufficient. Parents should also consider legal options such as structured loans or inheritance planning to balance their support while protecting their own retirement security. Without proper planning, retirees risk running out of money just when they need it most. Number 6. Loss of work, benefits and hidden subscription costs. Retirement brings freedom from the daily grind, but it also comes with the unexpected loss of workplace benefits that many take for granted. While working, employees often receive perks such as employer-sponsored healthcare, gym memberships, meal allowances, and travel reimbursements. Once retirement begins, these benefits disappear, and retirees must cover these costs themselves, often without realizing how much they add up over time. One of the most significant losses is private health insurance. Many companies offer subsidized health plans, but retirees must either switch to the NHS or pay for private coverage, which can be costly. Similarly, workplace pension contributions stop, meaning retirees no longer receive employer top-ups that once boosted their retirement savings. Travel expenses also change, as retirees may no longer have access to company-funded transport passes or fuel reimbursements, making personal travel more expensive. Another hidden expense is the accumulation of subscription services. During their working years, many people sign up for streaming platforms, software services, magazine subscriptions, and membership programs without considering their long-term costs. Once retired, monthly fees for services such as gym memberships, premium TV packages, and professional associations can quietly drain savings. Since these costs are deducted automatically, retirees often overlook them, leading to unnecessary spending. To avoid these financial pitfalls, retirees should conduct a full review of their spending and identify subscriptions and memberships that are no longer needed. It is also wise to research alternative healthcare and insurance plans that fit within a retirement budget. Budgeting for new expenses that were previously covered by an employer is essential to maintaining financial stability. Without careful planning, the gradual loss of workplace benefits and overlooked subscription costs can add up, creating an unexpected drain on retirement funds. Number 7. Higher utility bills and living costs. Many retirees assume that their day-to-day expenses will decrease once they stop working, but in reality, some costs actually increase, particularly household utility bills and general living expenses. Spending more time at home naturally leads to higher energy usage, as heating, electricity, and water consumption all rise. Without careful budgeting, these seemingly small increases can become a significant drain on retirement savings. Heating costs are a major concern, especially for retirees living in older homes that may not be energy efficient. During winter months, many pensioners find themselves relying on heating more frequently, leading to increased gas and electricity bills. Energy price fluctuations also make budgeting difficult, as utility rates tend to rise over time. Similarly, water bills may increase due to spending more time at home, using appliances, and running more frequent laundry cycles. Food and grocery expenses can also be higher than expected. With more meals eaten at home, rather than provided by a workplace cafeteria or subsidized meal plans, grocery shopping becomes a bigger part of the monthly budget. Inflation also plays a role, as the rising cost of essential goods means retirees often pay more for the same groceries they purchased years ago. Another overlooked cost is home internet, phone, and streaming services. Many retirees upgrade to higher speed internet or additional TV subscriptions, assuming they will need more entertainment in retirement. However, these recurring costs add up over time, especially when combined with mobile phone plans and home maintenance services. To manage these costs, retirees should explore ways to improve energy efficiency, such as insulating their homes, switching to cost-effective tariffs, and reviewing unnecessary expenses. Careful budgeting and reducing non-essential services can help retirees avoid financial stress while maintaining their desired lifestyle throughout retirement. Number 8. Loss of spouse's pension and income. One of the most significant financial risks in retirement is the potential loss of a spouse's income or pension. Many couples plan their retirement finances based on dual incomes, assuming that both pensions and savings will provide a comfortable lifestyle. However, when one partner passes away, the surviving spouse may experience a drastic reduction in household income, leading to financial strain at a time of emotional distress. In the UK, many workplace pensions do not automatically transfer in full to a surviving spouse. Some pensions may reduce payments by 50% or more, while others may stop entirely, depending on the pension plan's terms. This can leave widows and widowers struggling to cover expenses that were previously shared, such as housing costs, utility bills, and healthcare. Even the state pension does not fully transfer in all cases, meaning some retirees face an unexpected shortfall. Losing a spouse can also result in higher living costs for the surviving partner. While some expenses may decrease, others may remain unchanged or even increase. Single households often pay disproportionately higher costs for housing, council tax, and essential services. Additionally, if the deceased spouse managed household finances, the surviving partner may face challenges in adjusting to new financial responsibilities, leading to costly mistakes or financial insecurity. To prepare for this possibility, couples should review pension policies and explore survivor benefits in advance. Setting up joint savings accounts, considering life insurance, and ensuring financial literacy for both partners can help mitigate risks. Seeking professional financial advice and drafting a will can also provide clarity on inheritance and asset distribution. Planning ahead for the loss of a spouse's income is essential to maintaining financial stability and avoiding unnecessary financial hardship in later years. Number 9. The cost of boredom and mental health. Neglect retirement is often seen as a time of relaxation and freedom, but many retirees underestimate the financial and emotional costs of boredom and mental health challenges. Without the structure of a daily job, some retirees struggle to find purpose, leading to increased spending on activities, entertainment, and even therapy. While keeping busy is essential for a fulfilling retirement, the associated costs can quickly add up if not planned for. Social isolation is one of the biggest risks in retirement. especially for those who relied on workplace interactions for daily social engagement. Loneliness can lead to increased spending on activities such as travel, hobbies, and social clubs, all of which require ongoing financial commitment. While these expenses contribute to well-being, they can strain a retiree's budget if not factored into financial planning. Many retirees also face unexpected costs related to mental and emotional well-being. Therapy, counseling, or support groups can become necessary for those struggling with anxiety, depression, or adjusting to a slower-paced lifestyle. Private therapy sessions can cost between £50 and £100 per hour, making mental health care a significant but often overlooked expense. Some retirees also turn to retail therapy, dining out frequently, or engaging in costly leisure activities to fill their time, unknowingly depleting their savings in the process. To avoid these financial pitfalls, retirees should plan for meaningful activities that fit within their budget. Engaging in community groups, volunteering, or part-time work can provide structure and purpose without excessive spending. Investing in social connections early in retirement and maintaining an active lifestyle can reduce the need for expensive mental health treatments. Without proper planning, boredom and loneliness can lead to unexpected financial strain, making retirement less enjoyable and financially sustainable. Retirement isn't just about saving enough money, it's about knowing where your money will go. As we've seen, hidden expenses like higher taxes, unexpected healthcare costs, inflation, and home maintenance can drain your retirement funds faster than you ever imagined. Many retirees find themselves financially struggling, not because they didn't save, but because they didn't plan for these surprises. But now you know the truth. You're ahead of the game. You've uncovered 9 hidden retirement costs that most people never consider, and with the right strategy, you can avoid these financial pitfalls. The key is smart planning, budgeting wisely, and protecting your savings so that you can truly enjoy your retirement years without constant financial stress. Now, we want to hear from you. Which of these hidden costs shocked you the most? Are you already preparing for them, or did any of these catch you off guard? Drop a comment below. We read every single one and love hearing your thoughts. If this video helped you, help us back. We put a lot of effort into making these videos, and your support means the world to us. So go ahead, hit that subscribe button. It's just one click, but it helps us create even more valuable content for you. And don't forget to like this video and share it with someone who needs to hear this. See you in the next one.